I want to start really big. Cecilia, the Inflation Reduction Act, threat or opportunity?
At the IEA, we see this really as an opportunity. If we're looking at some of the IEA scenarios that call for a major transition in the way we produce and consume energy, we really need to see ambitious programs and supports from every country. And I think the shift that we've seen in the US and the ambitious support for climate action for the transition, we see this really as an opportunity. It could be an opportunity to further drive down costs that will be really critical in terms of achieving the global energy transition.
And Ben, in terms of the European response and the UK's response, putting Brexit aside, how can they work together in coming back to the Inflation Reduction Act?
Well, first of all, and thanks, Lizzy, and good morning to everyone. The US, I mean, we definitely see it as an opportunity. We definitely see it as something the rest of the world needs to respond to. And we can see governments everywhere kind of looking at how they're responding, they're scrambling to respond. And we think that's a good thing. The US now has certainty for 10 years. They will double their wind capacity in the next 7 years because of the IRA. We've seen a huge jump in new facilities being announced in the US in manufacturing, huge demand for grid connections. We, frankly, are waiting for the response from Europe still, I think. So the Net Zero Industry Act, which was announced earlier this year, I think is a start. And it contains a lot of very helpful provisions to try and get the market going, particularly around things like permitting. But there's no real equivalent to the IRA in terms of support for manufacturing. And also in terms of actually creating financial incentives for the industry. And I think that's the key thing that's missing. So there's a lot of new kind of demands in a way for local manufacturing, but there's not a lot of financial incentive to actually make the industry profitable. And I think that's the difference in the IRA. There's a direct effect on people's IRR. Whereas in Europe, that's not really clear where that comes from.
So I just want to put this into context, and I think our magical helpers have got a chart to show you of the impact of the Inflation Reduction Act and just how much investment it's brought about from in terms of the US. Cecilia, when it comes to the UK particularly, there are lots of warnings about how the response could turn into a trade war. Is that just an excuse because there are actually huge fiscal constraints?
I mean, I don't know about that. I think if we look at where we need to go in the transition, we really need all countries to act in terms of investing in more low-carbon technologies. And our analysis shows that these commitments and these announcements of government support, including the IRA, but in countries also like Europe, India, China, we will really only be meeting the announced policy scenarios of the IEA's outlooks, where we need to go to achieve the Paris commitment and address climate change is our net zero emission scenario. And if you look at the amount of investments that are going to be required for that, we still have, I think, tremendous growth for manufacturing around the world. So we would like to see this less of issues around trade conflicts, but really investing in opportunities for expanding the energy transition. And I think we should see the IRA as an opportunity, and countries should look at how they can collaborate more to drive down costs and support more global manufacturing in these clean energy technologies that we're going to need around the world.
But then, Ben, how do you stop the Inflation Reduction Act just sucking investment out of places like Brazil, for example?
Yeah, I think, that is one, I think, important issue. I mean, nearly all the investment last year that went into clean energy transition and manufacturing in particular was in either the developed countries or China. And I think that's a very, very big deficit, both from a material point of view of getting the transition done in developing countries, but also from a political and social point of view. I mean, there has to be something in this for all these countries. There has to be something in this for Africa, for Southeast Asia, for Latin America. And there is a danger, not so much that investors will leave these markets and go to the US, but certainly when multinational companies are making their investment decisions, the US will be a very, very attractive market to go to. And we've seen that already with some battery companies that have decided to go to the US rather than to other jurisdictions. And I couldn't agree more with what Cecilia said, which is that we need we need everyone. This is a huge step up. We're talking about just for the wind sector, something like 4 times as much in terms of annual installations by the time we get to 2030. In the IEA's net zero by 2050 scenario, wind goes to, I think, 8.3 terawatts. We've just passed the first terawatt a couple of weeks ago. So we need to go basically 8 times bigger by 2050. And if you do the numbers, that means we should be installing 3 to 4 times as much every year, which is in line with what the COP presidency is calling for at the moment, right? So we're going to need everybody and all of everything we've got right now and a lot more to get there. And it's quite worrying that we're focused on trade wars, protectionism and all these issues, when in fact we need a massive scaling up of manufacturing capacity and a massive scaling up of collaboration across the world.
Okay, so now we know what the goals are. I've got a poll for everyone in the audience to see what the biggest barriers to getting there are. So the question is, what could become the biggest barrier to EU industrial competitiveness in the green transition? A lack of funding from Brussels, failure to harness global talent, economic imbalances among member states, or confusing regulatory regimes? And we'll come back to the answer later on. And I hope you'll both have a think about what your view would be on that. Also, just to remind you, if you're in the audience, that you can send in your questions using the QR code, and hopefully we'll have time to come to those at the end as well. You mentioned China, Ben. Cecilia, let me ask you, can the West actually catch up with China's clean energy manufacturing might?
I think if you look at costs in China, the strength it has in terms of critical minerals, it's a big challenge to have an objective to try to catch up to China. And I think it's less about, as Ben said, about competing in issues of trade wars or protectionism, but looking at the opportunity to transition markets. So countries that are putting in place green industrial policies should really look at where they have an added advantage and worry less about, can we catch up to China? They should really be looking at, in this opportunity of the global energy transition, where does it make more sense for us to compete? And I think you see different countries identifying their strengths based on their national resources. And, it's less about trying to compete in all areas, but finding where we, as a manufacturer, as a country, have an added advantage in the whole transition. Because I think, as Ben said, and as our IEA scenarios show, the multiples of growth that we need to see in investments in manufacturing are so large that the business opportunities are enormous for everyone. And it's less, I think, about trying to compete with each other, but really getting those investments in place, moving forward with the transitions, and being able to actually keep pace with the investments that we need to put in.
But we're obviously in an inflation crisis. Ben, how much more expensive will the energy transition be if we're moving away from cheap Chinese manufacturing? How concerned are you about the inflationary impact of the green transition?
Yeah, I think first of all, it's really important to have diverse supply chains. We can't depend on one particular country, and I think that's entirely logical and was a consequence a little bit of the pandemic to kind of see those vulnerabilities, right? And we'd like to see, obviously, everybody getting local jobs and manufacturing opportunities from the transition. So I think that's a good thing. Now, in terms of cost, right? We need to be quite careful. As an industry, we've been used to having these constantly declining costs all the time, right? And the expectations of international institutions and governments, and even people like Bloomberg NEF, is that costs will continually decline. Now, our costs are probably almost 20% higher than they were before the pandemic. It's actually a reversal over the last few years, and that's because of much higher raw material costs. For steel, there was a big crisis around logistics. There's now higher financing costs as well. So we shouldn't assume that the energy transition is just going to keep getting cheaper and cheaper. So we have to be quite careful. We can't massively scale up and introduce more sustainability and circularity and try and do it all on our own in different regions and countries and expect things to still keep getting cheaper. And I think there's often a kind of disconnect as well between treasury departments in countries and departments which are looking at the energy transition and wider policy. I mean, treasury departments are still focused on trying to force down prices any way they can, and we have all these kind of single, price auctions around the world where they're just trying to force down prices, and then you get to a kind of race to the bottom pricing where companies can't actually make any money. And that's, we've seen that happen a lot over the last few years, and as a result of that, companies are losing money when they should be making money. So, I mean, just to finish, I mean, if you try and do all of that all at the same time, without doubt, the energy transition is going to be more expensive. Now, given that we're far more competitive than fossil fuels, there is a certain room for manoeuvre, but I think we have to be quite careful about costs.
But so that's the fiscal side, and even there you're saying it's not always joined up. But Cecilia, what about the role for central banks? The hiking interest rates again and again and again. Do they risk derailing the green energy transition by making investment more expensive?
I mean, I think this is, the role of central banks in terms of energy transitions is going to be about trying to incentivize more investments in the transition itself. Higher interest rates.
Would you go as far as Megan Green's suggestion for a dual interest rate, maybe a negative preferential interest rate for green investment?
I don't know if that's necessarily the role of the central banks to put that in place. I mean, I think this will come down to country incentives for encouraging investments in the sectors itself. This can be done through the central bank's energy interest rate policies, but more often than not, it's going to be done through industrial policy implementation. But it's true that higher interest rates will make the cost of the transition more expensive. But I think we can set in place financial regulation that will make it more attractive to invest in sustainable technology. And what we need to do is put in place stronger signals that we need to stop investing in fossil. So how can we really use financial market and fiscal policies to steer away from fossil fuel investments and more towards clean energy technologies?
So, Ben, what would you do in terms of those other incentives, especially when it comes to monetary policy? Do you agree with Megan Green? I should say she's the incoming member of the Bank of England's Monetary Policy Committee.
Look, I definitely think we need to get creative about how we do things and how we incentivize things, and business as usual is not going to get us to where we are. So I think it's a valid discussion in terms of making sure the financing is competitive.
What does that look like in terms of monetary policy?
That's kind of way above my pay grade, really, Lizzy.
Well, let me ask you on wind then. One of the biggest wind turbine suppliers announced they're going to lose over €1 billion to fix faulty turbines just last week. It's the latest setback for the wind industry. We've had years of losses, rising costs. Is wind power at risk of becoming uninvestable?
No, I mean, definitely no, it's not at risk of becoming uninvestable. But unfortunately, we've had this very kind of perverse paradoxical situation in the last few years where companies which are really at the heart of the energy transition, and the technology that's at the heart of the energy transition is the best way of taking out carbon from the power system per megawatt. Unfortunately, a lot of the companies can't make any money. And I think we need to look at the market and how it works. And again, as I said, I mean, we've driven renewables pricing to the floor for both wind and solar, actually. Whereas at the same time, the fossil fuel industry has been making record profits and reaping these windfall profits. And there's clearly something wrong there. We're not giving the investment signal to the companies for the renewable energy transition. So things need to be fixed. We need to stop talking about making renewables cheaper. We're already far cheaper than fossil fuels. And you can see in Bloomberg's LCOE figures that came out a few weeks ago, we are half the rate of fossil fuels in terms of average. So why should we be selling power at half the rate of fossil fuel? There's something wrong there and it needs to be fixed.
I like that. I didn't even ask you to cite Bloomberg figures, and yet you've done it for me. I think we've got some time for some questions from the audience. Has Meg got those for us? We'll come back to that. We can, though, do the answers to the poll. So we asked, what could become the biggest barrier to EU industrial competitiveness in the green transition? And you said, which we will put on the screen now. My magic powers just aren't working today. Okay, confusing regulatory regimes, 67%, economic imbalances, 15%, lack of funding from Brussels, 11%, and failure to harness global talent, 7%. Would you agree with that?
I would. I was going to vote for the first one as well.
Ben?
I would.
Do we have Meg? Okay. Let me ask you then, what other levers should countries be pulling to make the money go further, the money that governments are giving them? Could the funds be used in a better way to improve uptake, Cecilia?
I mean, I think one thing we haven't really talked about is when we talk about a global clean energy transition, how we can support emerging and developing economies. Because if you look at all of the forecasts of where investments need to go and where we're falling behind, our numbers show that about 90% of all of the clean energy investments have gone to advanced economies in China. Mm-hmm. We've seen some, areas of positive in countries like India and Brazil, but still too little is being spent in countries in Africa, for example, in parts of Asia. And if we really want to address sustainability, climate change, global warming, we really need to support these less developed countries in their transitions. And I think as an international community, we also need to not just think about domestic growth, but also how do we support broader transitions? Because it goes back to the discussion of the need to take advantage of opportunities to collaborate to see broader benefits. Because if you look at manufacturing, you get much lower costs in manufacturing in developing economies than developed. And driving down costs of different technologies will have positive benefits around the world. So, working together closer on supporting transitions, not just in our own markets, but I think in major developing economies is an area that we need to spend more attention on.
And Ben, how do you make the investment case easier in Africa, for example, when you've got a big package like the Inflation Reduction Act to compete with?
I think Africa, is a special case in itself in a way, in that, continent, huge, growing population, amazing talent, huge demand for power, and yet it's very, very difficult to get anything approved in terms of investment. There's an enormous amount of money, philanthropic money and development bank money, looking to go to Africa, but up till now, everything has been simply too complicated. And I think the instruments that have been chosen have been pretty complex. A lot of them have been around things like creating sovereign guarantees for companies around, for countries around specific investments in the power sector, and it gives you a kind of bit by bit kind of approach. I think something much more radical is required. A lot of these countries will require just a huge guarantee behind power production, behind offtake, in order to kickstart their power markets. We can't just wait for years and years of spontaneous market growth and power sector reform. I mean, this needs to happen now. And I think it can be done. We literally need to guarantee people's ability to install and sell and buy power. And then on manufacturing, I can't see a situation where somehow the West plus China builds solar panels and builds wind turbines and then sells them to the developing world, because what's the incentive for countries to transition? Where are the jobs? Where are the skills? How is the talent being given outlook? And we've really, I think, as an industry, changed the way we look at it. And I think we should go to countries with a proposition that's not just about we'll sell you some clean energy kit, but that we will transfer knowledge, we'll transfer skills, we'll build industrialization locally. We'll have other ways of doing offtake as well. So I think things like hydrogen and ammonia and how they fit into countries' economies as well give a lot of scope for local industrialization as well.
Well, on that call to action, I hope you'll join me in thanking Ben and Cecilia.